Thank you, Mayor. I wanted to give my appreciation and gratitude to the Public Works team. I know that they've been out there in full force the last few weeks, so I appreciate everything that the crews are doing out there, so thank you. Mayor, Council, I wanted to spend a little bit of time giving an update on two things, master tax sharing agreement and then development updates in the community. These are really relevant because they are topics of discussion right around this time. So just by way of overview for the master tax sharing agreement, on September 21, 2004, the city and county entered into a revenue sharing agreement. On January 6, 2009, there was a cancellation to the agreement due to a conflict between the 2025 Livingston General Plan policy for future growth of the city of Livingston and the county general plan. And then on October 22nd, 2019, the county brought an item before the board to enter into a new agreement with the city of Livingston. This agreement was approved by the Board of Supervisors following the first and second reading of the ordinance. The city did not act on the new agreement in October at a regularly scheduled council meeting. Some of the key items based on the 2019 or just the history for fiscal year 2004, 2005 to 2008, 2009, there was an 80-20 split. In 2009, 2010, and thereafter, there was a 70-30 split. One of the key points in that agreement was that the county fire fund will retain the base property tax for the county fire fund, and pursuant to section 96.5, the county fire fund will retain the incremental tax rate for the county fire fund. For the mayor and the council, we talked about this at the last council meeting when it came to how to fund any sort of new staffing levels at the city's fire station. Again, effective, and this is the 2019 agreement, effective January 1, 2024, the city agrees to share 5% of the city's 1% Bradley Burns sales tax receipts with the county of Merced. As a result of the agreement, the city's rate would be 95% and the county's rate 5% of the total 1% Bradley Burns sales tax receipts. This is really important because when we talk about any sharing of revenue with the county, it's really important because in the 2019 agreement, the proposal would see that 5% of the city's sales tax would be remitted to the county. So essentially the city would be operating from a 5% loss of revenue, and it would need to make that up somehow. So those are the things that are really relevant to financial solvency for a community into the future. Again, some more details related to that 2019 agreement. The county shall receive 100% of the county fire fund ad valorem property tax revenue from each annexation area. And again, this is really technical policy related to the tax sharing agreement. This is purely just included here as background so that the community understands what's really at stake with this conversation. Part of the conversation, and we just had a meeting today with Mayor Moran, Supervisor Espinoza, Supervisor Silvestre, and also the county CEO, Raul Mendez. And some of the things that we have been talking about that are really relevant for this specific time is that this annexation, this tax sharing agreement really should focus in on policy areas and what the potential growth is for the city of Livingston. Staff is currently looking at hosting a joint workshop with the Planning Commission and the City Council to really look at those policy areas with respect to growth, because we know that based on whatever that zoning is in those areas, there's potential opportunities for growth, and that really stipulates the amount of revenue that would go into any sort of tax sharing agreement. There's a key policy item with respect to the fire fund. Should that remain with the county or should it remain with the city? We talked about at the last council meeting that having the county retain those revenues really hamstrings the city's ability to look at other options to provide fire services to the city of Livingston. One of the core items, and we spent a considerable amount of time this afternoon talking about it with the county, is as a result of any sort of annexation of new areas into the community, there's a fundamental question: who will service the new area? We know that with areas that were once the county that then become the city will be responsible for providing police services, recreation services, public works services. And so there should be an offsetting revenue that goes into factoring in to cover those additional levels of service for those now formed city areas. And from the city's perspective, it's really important to get an understanding of what those costs are. Again, sharing, as I mentioned in the previous slide, sharing of existing sales tax versus any increment or growth in sales tax. Taking a proportion of base sales tax, of existing sales tax, means that the city needs to identify what revenue stream it's going to utilize to cover that loss of revenue. And that's really important, again, for the financial solvency of the city of Livingston. Again, on that same note, the long-term sustainability of Livingston is critically important. This means service solvency and the services that we provide to the community, such as police services, but also financial solvency, because without financial solvency, you're unable to provide services to the community. So looking at it from that perspective is really important for the city of Livingston. One of the approaches that I think is probably a new approach based on having these conversations with the county is that the city has taken an approach to present facts, data, and policy level questions to the ad hoc committee, so that when we're talking about this with the county, we're being transparent. There's a rationale for why we're recommending certain areas be focused in on, because at the end of the day, staff makes recommendations to the city council, and the city council really operates at that high-level policy area. And so it's really important for the staff to have a good understanding of what the facts are and what the data are, so that we can make a recommendation to the city council. As I mentioned, we talked about being rooted in data and facts and rationale. We brought on Baker Tilly to assist us with developing a long-term financial model. And this is really critical because we have factored into our financial model the cost for two-person staffing. And you can see based on the graph here that adding the additional cost of $750,000 for the additional staffing means that the city would need to utilize fund balance or its savings account to pay for that, because there's not a new revenue stream to accommodate that. And I give kudos to the council for approving the agreement to do some polling for the community with respect to a potential sales tax measure to help fund the additional fire services in the city of Livingston. You can see the chart on the right gives a pretty grim picture when it comes to the long-term sustainability of the city's finances as it relates to adding new levels of service for the community. As we start talking about hypothetical examples of a tax sharing model, we looked at the 2019 agreement, and we know that there's going to be additional levels of service that are needed for the city of Livingston to service the new parts of the community. So the hypothetical example that we took is we added 1 FTE every other year, which reflects a moderate estimate for the increased workload and the desire to improve current levels of service to accommodate and service the new levels or the new parts of the community. You can see that the cost grows, and you can see what it does to the fund balance. And so you can see that by fiscal year 33, the city is running a really bad deficit situation without some sort of discussion related to how do you accommodate that growth in the community. So what we did is we took the 2019 draft agreement that the county had provided to the city of Livingston, and we plugged in a hypothetical scenario into our financial model. And so what we did in this instance is that we assumed 1,000 new residential units between fiscal year 27 to 2031, 50 million worth of non-residential value, and then added revenue of 300,000 sales tax and 50,000 in transit occupancy taxes. You could see that as a result of the growth in revenues, you can see what that means in terms of the potential revenue that gets gained as a result of that. So you can see that even in this scenario, adding 1,000 units would essentially be a net, it would be a bad financial situation for the city to be in. And this really goes back to the theme of what the city of Livingston is talking about, is that any sort of master tax sharing agreement needs to make financial sense from the city of Livingston. So the position of the county can be whatever their position is of what a tax sharing agreement should be. From the city of Livingston, we need to make sure that we're prioritizing future expenses and ensuring that any tax sharing agreement is structured in such a way that it doesn't create a deficit for the city of Livingston. So that concludes the update on the tax sharing agreement. We had a good conversation today, and from the ad hoc committee, I think what we were really trying to drive home today was the city of Livingston is recommending looking at the expenses and future growth of the community and using that as the baseline for what the tax sharing conversations really need to be about with respect to a new tax sharing agreement. So now I wanted to